Hi, it's me again. There have been some reports from students that the second part of the income tax video didn't come out with the soundtrack. I can't find out why, and so I'm quickly going to just record this as a screen record. The second section is about tax allowances, and you start off with when is revenue expenditure deductible in terms of the general deduction formula. Now, the two important provisions on this are Section 11A of the Income Tax Act. That is the general deduction formula, but you must remember that it is always limited by Section 23. So Section 11A says that you may deduct from carrying on trade expenditure and losses actually incurred in the production of the income, provided such expenditure and losses is not of a capital nature. Now, that is immediately tempered by Section 23. It says that no expenditure may be deducted in certain circumstances, and the important issues there are para A, which is the cost incurred by the taxpayer in the maintenance of his family or himself. Those are your clothes, that's your house, etc. There are tempering provisions to that in Section B, which says that you can claim expenses relating to your house if it is occupied for purposes of trade. The important issue there is that you don't have an office at work. Again, this is not stuff I'm likely to examine. So there's the requirement that you can have your home office. Another important provision is item C in Section 23, where any loss is recoverable by way of a contract of insurance or a guarantee, security, or indemnity, then it can't be deducted. Some people get excited about it when they get a loss from, for example, a fire or something like that. Well, you can't claim it if it is insured. Then, important from a governance perspective, is that any tax, levy, interest, or penalty imposed in terms of the taxing acts is also not deductible. Now, this is important when people do not pay their tax on time because they have a cash flow problem. So what you would have with that, for example, is somebody's got a cash flow problem, they want to pay their creditors, so they don't pay their VAT. If you do that, the interest is not deductible, and so the cost of interest in borrowing from SARS is very high, not to mention that you can get a penalty on it as well. Also important from a governance perspective is particularly VAT and PAYE. In those capacities, you are a representative taxpayer, and consequently, if you don't pay your money over to SARS, a criminal charge of theft can arise if you use SARS as a banker. So I certainly wouldn't want to do that. Item F, the important provision there is that you can't claim or deduct money if it doesn't produce income as defined. Now, that the most often where we see that applied is where we have got expenditure in the production of dividends, because dividends we saw under Section 10 is exempt. Then, the absolutely vital one is Section 23G. No monies can be claimed unless they are derived from trade. So it says you cannot claim a deduction to the extent that such monies were not laid out or expended for purposes of trade. This is a far-reaching provision where SARS can inquire into the motive of the taxpayer, be it conscious or subconscious, and that leads actually to more disqualifications of deductions than Section 11A itself. So remember, 11A has two components to it. It is followed by Section 23G. Then, don't worry too much about expenses that are incurred in paying restraint of trades under L, but a very important provision under O is that no expenditure is deductible if it constitutes an activity that is identified in Chapter 2 of the Prevention and Combating of Corrupt Activities Act. Now, a lot of people are getting caught out with this. If I pay a bribe, I'm intending to make money. That will pass Section 11A. It will also pass Section 23G, but it is excluded in terms of Section 23O. A lot of people have had problems with this, where they have paid monies that are acceptable in terms of Nigerian law, for example, and they've found that it's not deductible in South Africa. Then, also, you cannot claim any fine from an activity that is carried out in the Republic. So if I'm on my way to my meeting and that's to make money and I get a traffic fine because I was speeding, not deductible, strictly speaking. The revenue expenses are then continued in various sub-provisions. So you have special provisions relating to your legal fees, repairs, pension and provident fund contributions, and the support of employees. There are also other provisions relating to insurance premiums, research and development, and donations. Now, those are the smaller, what we call sniper provisions in the Income Tax Act, and I don't expect an MBA to know those for exam purposes. So, your tax allowances start off with expenditure incurred, and we've looked at revenue expenditure. Now we have to look at capital expenditure or allowances. Revenue expenditure was dealt with under Section 11A, read with Section 23G, and then followed the specific allowances. Capital expenditure next up are the specific allowances for the assets that you acquire and consume in your business. Now notice that there are a huge number of these allowances across a wide spectrum. Again, we're not expecting an MBA student to know these in any great detail. What we're expecting you to know is that there are specific tax allowances for the various types of capital expenditure. So what we get with this is that there are allowances for fixed property. So rental, you can deduct. But then when we get lease improvement expenditure and lease premium expenditure, there are write-off provisions over a number of years. If you ever get involved in property transactions involving lease agreements, please remember that not all lease payments are immediately tax deductible. This is a thorny issue within tax, and it's probably best to get some professional advice. Then there are the general provisions relating to all the assets that you write off over their useful lives. And there are specific allowances for plant and machinery, which is written off 40% in the first year, 20%, 20%, 20% in the subsequent 3 years. Or if it is second hand, it's written off over 5 years, 20% each year. So those are flat rates irrespective of the life of the asset. Continuing on from that, we have special allowances relating to small business corporations contained in Section 12E and B. Those allow plant and machinery that is used in a small business corporation to be written off in full in the year that they're acquired. Second-hand machinery written over 50, 30, 20. SBC tax rates are not only confined to the rather attractive tax write-off if you are conducting a manufacturing process, we also get the small business corporation definition. Now, a small business corporation is a company. It does not extend to life where you carry on trade as an entrepreneur in your own name, where the entire shareholding is owned by natural persons and the gross income doesn't exceed 14 million per annum, and none of the shareholders during the year of assessment own any interest in any other companies other than listed shares or stokvels and unit trusts. It's very important that you look at that test the moment anybody else has, the moment any one of the shareholders holds a share in another private company, you are out of the loop of being in small business corporations. And then not more than 20% of the gross income can consist of investment income and that you're not a personal services provider. If you can achieve all that, there is a sliding rate of scale that is given to SPC taxpayers, where the tax escalates up to 550,000. We don't just get the 28% tax rate. Now, that can be worth, at income level of 100,000 Rand, about 90,000 Rand a year incentive to form an SPC. It's very attractive for the smaller SPC. The problem is the 14 million Rand threshold of turnover is a bit low, but there is something there that you could do. There is also the micro business schedule. That's the 6th schedule of the Income Tax Act, where a taxpayer has a trade and the turnover is less than R1 million a year. Well, then you can actually register for micro business tax. There we are paying tax according to turnover. There's no tax up to 335,000 Rand turnover. It's capped off at R1 million, where the tax payable is only 14,150 Rand. There is a definition that you have to go through to be registered as a micro business. Basically, it throws out anybody who is in professional practice. They can't get into that system. But it's therefore, shall we call it, survivalist business to keep SARS out of the way. So, what are we looking at? We're saying there are also finally commercial building allowances. You can write off a new commercial building over 20 years, 5% per annum. If you buy it second-hand, you don't get anything. So we get then residential allowances, residential building allowances in terms of Section 13. That's getting very specialized. Doesn't apply to all residential units. You have to own 5 units. So there that one is. And finally, we get the urban development zone allowance, where you go into the old city centers and you are part of regeneration projects. There you can get something as well. Those are very specialist allowances. We don't need to go to them in any detail in an MBA program. Finally, there are specialist allowances for rolling stock, hotel keepers, aircraft, port assets, and industrial projects that are approved by the Department of Trade and Industry. Remember, with a company, it pays provisional tax. It doesn't pay tax monthly. It's every 6 months. You would pay your first provisional payment based on what your taxable income was in the previous year of assessment. And then you will make a second payment at year end. Provisional tax can get awfully technical, but the bottom line on it is that by the year end, we are required to have paid most of the tax. It's good to get professional advice on that and keep on the right side of the law. Again, I wouldn't expect an MBA student to know how to calculate provisional tax. There is sometimes a third provisional payment or a voluntary payment. That used to be a very big part of it, but today most tax is paid by the second provisional tax payment at year end. Right, so that's what you've got in the second video. There's not much examinable there, just to fill out on what we had in the first video. Thanks for your attention.